All right, welcome to the weekly prep video for the week of July 7th to the 11th. In this video, I'll be doing a deep dive into all the price action from last week, including a look at the indexes, liquid leaders, and sector and industry ETFs. Once we get done with that, we'll be looking at a secondary indicator that's flashing a warning sign that this rally might be coming to a close a little bit sooner than you may think. Finally, we'll wrap up the video with long and short setups that I'll be watching for going into next week. But before we get started with that, I have exciting news. The platform that I use for all of my screening, charting, stock research, and historical analysis, DeepView, the one that we're using in this video, is having a promotion over the next couple weeks where you can try it out completely for free for 30 days. You don't even have to put in your credit card information. It's a complete risk-free trial. So if you guys are interested in using DeepView, I'm going to be linking that in the description and the comments section of this video. And then tomorrow I'll be coming out with a video about how I use DeepView throughout the day for my weekend research and all that. Not only that, but DeepView allows users to share screens, to share watch lists and dashboards. So everything that I have with those screens, watch lists, and dashboards, I'll be linking in the comment section of that video so you could use the platform exactly how I do. Now, with that said, let's jump into the video and taking a look at the NASDAQ, the QQQ, on a daily chart. Last week, up another 1.5%. Great action, even after, or even for a shortened trading week. We had a half day on Thursday, no trading on Friday because of the 4th of July. And we had a stress test last week. On Tuesday, we had a gap down, kind of growth stocks got hit pretty hard, but we still closed at the 5-day EMA on that day. Wednesday, we opened on the low with a slight gap down, closed at the high, and then on Friday, we followed through with a gap up and a strong close. So NASDAQ getting a little extended, especially from the 50-day moving average right now, but um, definitely acting like you want. SPY, the S&P 500, a little bit stronger than QQQ. That distribution day that we saw on Tuesday, not as felt in the S&P 500. We saw growth stocks pull back, but money stayed within the market and kind of rotated to other areas, and that's why you saw the S&P 500 outperform the NASDAQ on that day. Friday, gap up, strong close. You could see we're really accelerating after we made new highs here. The growth side of the Russell 2000, IWO, strong gap up, strong close on Friday. Looking to the left, we're getting into this potential resistance area where we chopped back in February of this year. So it makes sense that if we get up into that zone, while a lot of the other names are extended, that we might start to see some volatility pick up and maybe a pullback and some consolidation. ARKK, another kind of ETF that I use to measure the growth stock market to see whether it's a favorable or unfavorable market. I don't really like to use the words like bear market and bull market. I just want to know if the market is going to be high probability for me to make money on the long side or low probability. And when ARKK is above a rising 21-day EMA, sorry, there's 20-day EMA. When it's above the 20-day EMA, it's usually a good market for growth stocks. And we had great action after that Tuesday stress test that bounced off the 10-day moving average. We had a subtle gap up on Wednesday, a subtle gap up on Friday, and a close at the high of the year. So ARKK, lots of strength there. Bitcoin, BTC, pulling back a little bit on the weekend here, but still putting in a higher low on Tuesday with that stress test. Big move up on Wednesday. Really looked like we were going to start to accelerate and break out of this little handle. But then the rest of Thursday, and then so far this weekend, we've just been pulling back into that 10-day moving average, which as long as we put in a higher low there and don't accelerate down past Tuesday's low, I still think that this could tighten up and get going for another move out. Next, we'll go to the liquid leaders, and we'll just sort this by percent change for the last week. Robinhood led the way, up 13.7%, but we did get a gap down on Friday after it wasn't included in the S&P 500. Once again, down 3.7%. Below the day bounced at the 5-day. We still closed over the HBC, the high volume close from, I think that was Monday. Yeah, from Monday's close. As long as we're over the 5-day and above the HBC, I don't see any warning signs with that. The one gap down is something that I'm keeping an eye on, but this is just a single day. We don't even know if we rally on Monday, if we can close above that. Usually, if you close a gap down quicker, that shows sign of strength in the market or that individual stock. So right now we have one gap down that's maybe like one strike against it, but everything else, Robinhood is doing well. ORCL, this is a new addition to the leaders list. I took out Spotify. Spotify closed at the 20-day EMA on Tuesday, followed through on Wednesday, and then did reclaim the 20-day on Thursday, but it's a little bit weaker overall. So I ended up going with ORCL to replace it. Had a big gap up on earnings, up, what was that, 13%, and then flagged into the 5-day EMA. Had another big gap up that looked like it was potentially a reversal, but we saw that strength on Wednesday and Thursday, ending the week up 12.7% and really showing some strength here off the lows from 120 to about 240, about 100% move for a very liquid stock. Royal Caribbean basically just going straight up another 8% last week. I've said this before, but I was on a Royal Caribbean cruise during this weekend. I got back on Monday, saw that it was gapping down and shaking out the 20-day moving average, but I was traveling back home that day, and that ended up being the low. We shook out that 20-day at 260 and has been straight up since then, ending Friday up to $333.84. CRWV, I was using this and starting to get a little concerned about the market after that stress test on Tuesday, where we kind of tried to break out of this little consolidation, squatted, and then followed through. Sorry, followed through on Tuesday. That was Monday. This shortened week is messing me up. Pulled back into the 20-day EMA, but on light volume. And then we had a strong gap up and reignited the move back through the 5 and 10-day EMAs, closing right at the highs. This is going to be a really good test for the market, whether we follow through to the upside and really start to accelerate for potentially a blow off top, or if this was just kind of a relief rally on a shortened trading day. And if we get a gap down, like a potential lower high here, and then follow through to the downside, that would be a signal that momentum is leaving the market. But we don't have to guess. We can kind of just watch and see which way the market breaks. CrowdStrike, new highs on Friday with a gap up, opening on the low, closing right near the highs. Had that shakeout on Tuesday to the 20-day EMA and support gap. That was a potential buy point for my system. Whenever you shake under a support gap and a key moving average like that, re-entering the low of the support gap would be your entry, and then your stop would be the low of the day. So I didn't take that trade, but that is one of the setups that I tend to trade a lot. And especially in a strong market, those work well. So CrowdStrike with Zscaler, I'll jump to next. Both cybersecurity stocks that are acting well above all key moving averages, right near highs or making new highs. ZS has this small resistance gap that it still has to eat through, but overall, great action after Tuesday's shakeout under the 10-day moving average. NVIDIA, another new high on Friday with a gap up. Kind of a weaker close overall, but still over the 5-day moving average with a gap up. Can't complain about that. This has been a monster off the low, going from 87 to 160, about a 90% move, if I'm doing that mental math correctly. Whenever NVIDIA is doing well, the market tends to do well, and it's good to get the king back on top. GEV gap up on Friday, closed back over the 5-day moving average and the rest of the key moving averages. That shakeout nearly got to the support gap. That's the spot that I was watching for GEV. Didn't quite get there, unfortunately. But overall, great action. End of the week down 0.4%. So you're starting to see volatility pick up a little bit. If we lose the 20-day, and especially if we lose the low of Tuesday's shakeout, that would be a potential sign that the market needs some time to consolidate. And Roblox, end of the week down 2%, still over the 5-day moving average after the distribution day on Tuesday, down 4.35%. Never tested that 20-day moving average. The spot that I would be watching for is a shake under the 20-day and the gap zone at 97 after a market pullback. That would be a really good risk reward spot to watch. Next, we'll go through the industry ETFs. Because this is a weekly recap, I'm going to go through every single one. I know that might take a little bit, but that's what we're here for. You could use the timestamps to jump ahead if you want to. First one to talk about is solar, TAN, up 13.6% last week. I've said this before, I'll keep pounding it on the table. I think solar has bottomed. We got that bad news on the 17th where solar companies are not going to have the tax incentives or the tax write-offs. And instead of breaking, well, it did gap down, but instead of following through to the downside, losing the 50-day moving average, making a new lower low, we opened and immediately got bid up. We had a little bit of a sell off into the 23rd, but that was a higher low into the support gap, into the 50-day moving average. And then since then, we've just been seeing massive accumulation throughout the group. And stocks top on good news, they bottom on bad news when that price action is reverted. So if you get good news and you can't break any higher, it's a sign of a potential top. If you get bad news and can't break any lower, it's a sign of a potential bottom. And I think the price action last week has signaled that this has put in a low. And it's going to be a group that I'm going to be pretty focused on in the second half of 2025. But just because it's put in a low doesn't mean it's ready to go straight up. I still think there's going to be a lot of volatility in the group overall. But we've seen multiple reasons why this has bottomed. So looking for pullbacks for potential entries there. BLOK, second highest performing stock or ETF last week, up 6.6%. This is the kind of crypto slash blockchain ETF. Robinhood is the main kind of liquid leader in this, and you can see made new highs on Friday. Did squat a little bit with the Robinhood weakness, but over the 5-day moving average, whenever a stock or ETF is making a new 52-week high, that's not a bearish sign overall. Is a little bit extended though. XME, metals and mining ETF, just basically traded sideways after that very strong move on Wednesday, trading right at new highs, did close at a new high on Friday. GDX, gold miners ETF, just gets supported at that 50-day moving average again. So good shakeout, gapped up the next day, kind of reversed at the resistance gap, came into the 5, 10, 20-day moving average, found support, and now we're right back at the resistance gap. So this will be a good test. If we close above it, chances are we're about to rally into new highs. If we uppercut and fail at that area, that's showing that sellers are still showing up by the end of the day, especially institutional sellers. And maybe we're seeing a little bit more distribution at the top here. We rallied into new highs, but for the past couple of weeks, we've not been able to actually um, trend higher. We've seen a lot of distribution and a lot of volatility here. So we'll see how we handle that resistance gap next week. XRT, the retail ETF, very strong action on Tuesday, follow through on Wednesday. So Tuesday, the growth stocks had that distribution. Retail and some of the lagging ETFs, lagging industries got that rotation and had a great day. Finished that day up 3%. Followed through on Wednesday and Thursday. XLB materials ETF, we see that rotation as we pop through the 200-day moving average, push through on Wednesday, and then a little doji on Thursday. Great action overall. ITB, home construction, huge rotation on Tuesday, kind of inside day on Wednesday, down on Thursday, but still closed above the 5-day moving average, potentially putting in a low here, but still one of the weaker industries overall. IGV, the software ETF, made a new high on Friday, gapping up, opening on the low, closing right near the high. Great action overall. IYT, gap up on Friday. We're back through all the key moving averages, but the order of those still need to sort out a bit. XBI, biotech ETF, starting to form potentially like a little consolidation under this resistance gap, pushing that, and we probably get to the 200-day moving average at 90. But another one of the weaker groups in the overall market. ROBO, the robotics ETF, really has this massive base that it looks like we're breaking out of. If this is just an uppercut and fail, and then we actually put in a higher low, I think that would be a more healthy structure to the overall base instead of just ripping out at this point, because we really haven't had much time to consolidate overall. So For the long-term health of the group, I think kind of an uppercut, fail, pull back, consolidate, and then go in a couple weeks would be a little bit more healthy. But another group that has obviously joined the market rally. XLF financial ETF, another gap up and close at new highs on Friday. That's a great sign for the overall market. XLE, a little bit of weakness still. We close over all the short-term moving averages, 5, 10, 20, but still under the 200-day, still under this distribution day on the 23rd. And overall, just not going anywhere for a very long time. So not a group that I'm focused on right now. PEJ closed at a new high. That's the leisure and entertainment ETF, basically going vertical at this point. XLP, consumer staples, right at this resistance gap. You can see a pretty wide base that I thought was going to be breaking to the downside here, but put in a nice V recovery last week as we got that rotation out of growth and into the rest of the market. So that's good to see. IYZ, new highs, really railing and holding that 5-day moving average with multiple gaps. Semiconductor ETF, SMH, new highs on Friday, another gap up and kind of middle of the range close, as we saw with NVIDIA, not the strongest close, but still a positive. Sorry, I keep saying Friday, shortened trading week, Thursday. I mean, cybersecurity ETF, CIBR, new highs, gap up, open on the low, close near the high on Thursday. Great to see. XOP, similar to XLE, just under the 200-day moving average, under that distribution day from the 23rd. Overall, just a weaker group. It did hold the support gap, so maybe we're putting in a higher low here. We can rally, put in another higher low, and then get going eventually. XLY, consumer discretionary ETF, put in a couple weeks of consolidation into the 200-day moving average and has since been rallying through. Another group participating. XLV, end of the week up 1.1%, but does have that gap down from Tuesday to Wednesday, inside day on Thursday. We're still one of the weaker groups, if not the weakest group in the market overall. This is the healthcare ETF. FDN still needs to get through this resistance gap. This is the internet ETF. Gapped up on Thursday, got through the 5-day moving average overall, acting really well. ITA, a little bit weaker last week, down 0.3%, but still closed over the 5-day moving average with multiple gap ups. Had that distribution day on Tuesday and then just consolidated from there. NLR, the nuclear ETF, distribution day on Tuesday. A little bit of kind of bear flag action into the 5-day and the 10-day on lighter volume on Wednesday and Thursday. I still think that this can pull back, put in a lower low, but undercut the 20-day and support gap. And then that would be overall in the structure, kind of like a higher low, and really a spot that I would be watching for a low risk entry point, because that's to me a do or die spot for the uptrend to continue. And those are the spots that you could size up the most with the tightest amount of risk. So if it works out and pays you multiples of your risk. And if it doesn't, it's a really tight stop. And the last ETF that I want to cover is KWEB. This is the China ETF, China Internet ETF. And I've covered this the last couple of videos, but I think this has the best base that I see in the market. If we go to a weekly chart, we can see that this group really hasn't gone anywhere in the last couple of years. We had that major sell-off from February of 2021 when all the growth stocks topped after the 2020 massive rally. And from there, we've sold off to the bottom of the bear market in 2022 and has just gone sideways for the past 3 years. But we're starting to get really tight price action on the weekly chart and on the daily chart, you could see. So from big bases and tight price action, you get expansion and sustained moves. Now, the direction, I'm not quite sure. I expect it to break to the upside because everything else in the market is breaking to the upside. But it could easily break to the downside too. This week was relatively weak, down 2.6%, while the rest of the market was strong. But I have had this happen multiple times where I see a massive base like this. I'm all bowled up. I'm ready to kind of jump on the leaders in that group. But then it has just 1 or 2 weeks where it doesn't move with the rest of the market or it has relative weakness. I take it off my focus list, and then in a week or two, it breaks out, and then I either have to chase some of the names or I don't trust the breakout because it had a week or two of relative weakness, and then I miss the entire move. So I don't want to do that this time. I see the massive base 3 years in a row. We're starting to tighten up on the right side. We're in a strong market overall. We had a week or two of relative weakness to shake out some of the weaker hands. And now we just need good news to kind of ignite this uptrend. Whether it happens or not sure, but it's a base that I can't ignore. Okay, so we've gone over the indexes, the liquid leaders, and all of the industry ETFs. Everything looks great in the market, right? We haven't seen this many industries participating. We haven't seen this type of action out of the growth stocks, and the indexes are at all-time highs. No reason to be bearish, right? Sure, but if everyone is buying and everything is at an all-time high, who's left to buy? And that's exactly what we're getting if we take a look at the NAAIM number. So this is a weekly report of the active investors along with their percent exposure to the market. Last week we were at 81%, which is perfect. It means that there's an active bid in the market. We're probably going to get supportive action, but we're not overbought. Not everyone's already in the party. And that's why when we had the stress test on Tuesday, we went from 80%. You saw, instead of a full market meltdown, you saw a distribution from the growth stocks into some of the safety stocks into the rest of the market. And we saw everything else get bid up so much that the exposure level raised from 81% to 99% in 1 week. That is concerning because once everyone's already at the party, once everyone's already long, now if we start to get some bad news, you're going to see a lot more people being forced to sell, being forced to liquidate some positions. And instead of just a 1 day kind of stress test where we pull back to the 5 day, you now have the environment where everyone's going to be in. We're going to see a lot more supply have to come out of the market and either a further pullback or a sharper pullback. Now, we saw this in 2020. We zoom back on the cues. I keep using 2020 as the comparison because that's the last V recovery that I saw in the market. If we go back to 2020, once we made new highs, we accelerated into new highs with multiple gap ups, just like what was happening this time around. And then we saw a big distribution day down 5%, and then volatility for the next 2 or 3 weeks before we started a nice uptrend, basically a march into the eventual blow off top in September, and then a 3 week base. So I kind of think that's what we're going to get around now. Can we go higher? Yes. NAAIM numbers, they're not capped at 100. I think the highest it went to was like 118. But it does mean that things are starting to get long, or exposure is starting to get a little overbought. Everything's starting to get a little extended. And now the best risk reward is probably to the downside or some shorts. And if we look back at a tweet that I made or a post that I made on X, I think at the beginning of June, there were three warning signs that I was looking for in the market. NAAIM exposure over 95%. We have that now with that at 99. Unfilled gap down or multiple on the indexes. We don't have that yet. We've had a string of gap ups, which you also tend to see in accelerated moves before a sharp pullback, but we don't have a gap down yet. And third, a large volume breakdown of a liquid leader like GEV, Hood, Palantir, or Netflix. And one name that you didn't see on my leaders list was Palantir because we had a high volume breakdown on the 27th where it dropped 9.3%, broke through the 5 to 10, the 20-day moving average. We had a quick gap up on Monday that sold down through those moving averages on Monday, Tuesday, and then just tight trading, kind of a bear flag into the 5 to 10, the 20-day on Thursday, instead of ripping through those with the rest of the market. So we have two strikes against the market on the three warning signs that I'm looking for. So with that in mind, I do have 10 long setups to cover in this video, but I'm going to be using these, if I do trade them, as quick performance boosters instead of trying to build a core position. The best time to build core positions in liquid names is coming out of a correction, not when things are accelerating at new highs, when exposure is over 95%. So all these names, I'm looking for kind of quick base hits, doubles, maybe with smaller position size, and I want to be right immediately. So if I put the position on, I'm up 1 or 2%. My stop's going to be at break even. I'm not trying to take any losses on long positions at this point. So first stock to cover was D-Dog. This had the highest volume in over a year on Thursday on a half day, which is insane. Up 15%, closed near the high of the day, open near the low of the day. So this is one where I'm looking for a gap up, a pullback intraday to that 155 kind of 26 area, whatever the closing price was. Um, that HVC area, try to build a position there with a 1 or 2% stop, and then see if this can reverse and have a nice kind of check mark rally on Monday. CRWV, we covered it in the liquid leaders. I'm glad that it gapped up on Thursday, got through those key moving averages. This is one where if we just open week or we have a quick shakeout in the morning, recapture the VWAP, and then take out today's high, that would be a potential entry versus the low of the day as this really kicks into an accelerated move and a potential blow off top. NXT, this is the liquid leader out of the solar ETF or out of the solar stocks. Like I said earlier, I think solar is one of the groups to focus on in the second half of the year. And this is already making new highs. Whenever you have a stock within kind of a weaker group that's coming out of a stage one base that's already at new highs, that's the stock that you want to focus on. We had tested the 50-day moving average on Monday, held it twice on Monday, on Tuesday, gapped up through the 5, the 10, the 20-day on Wednesday, and then gapped up and had a strong move on Thursday. With this, I'm just looking for a pullback into the 5-day moving average, into a breakout retest at that $61 area. Stop would be the 20-day moving average. SEI, this is another kind of solar play, a stock that's not quite at new highs yet, but you could see getting there, right? New highs is right at $40. We're at $32. Couple shakeouts on Tuesday and Wednesday, and then strong action on Thursday. What I'm looking for here is a breakout retest of $30. So buying it as it pulls back into that area, then put my stop just under the 10-day moving average. Probably give it 2 to 3%. Hopefully, if that happens in a couple of sessions, you can put it under the 20-day moving average as well there. SMR, this is a energy name in that nuclear theme that we covered earlier. I still think that it could be a theme to focus on. And I think it's at a do or die spot, right? We came into the 20-day moving average, bounced, and then came right back in there. We've closed under it 3 times. And a lot of growth traders will basically take stocks off their watch list, off their radar when it closes under the 20-day. And that's why I love drawing these support gap zones because it gives you another layer of potential support that if you're just using moving averages, you probably wouldn't see. But we undercut and held that area on Thursday. I'm looking for either more weakness on Monday where we undercut and reclaim that area at 34.60. Then the stop would just be whatever the low of the day is for a really tight stop, or taking out Thursday's high as an entry. Stop would be the low on Thursday. And then just play this for a potential kind of rally into new highs. FUTU, this is one of the liquid leaders out of China. I covered KWeb before we jump to the long setups. So we're looking at a stock that's near new highs. The 2020 highs were at $200, so not quite there. But since the bear market low, we've continued to march higher while KWeb has not quite done the same, going sideways. This is one that I'm looking through the kind of 2-day pivot of Wednesday and Thursday. Stop would be the 20-day moving average, giving it a little bit more room to work with. Or if we gap up and then kind of take out the highs here, that would be an opening range break, buy, and then the stop would be the low of the day. LEU, oil and gas theme, monster move from 50 up to $200. Came in, shook out under the 20-day EMA. Since then, has been bouncing between the resistance gap and the 20-day moving average and support gap. Another test of that area would be buyable, and then the stop would be. I, w- I wouldn't put it at the low of this shakeout. I would probably put it like at 159, just under 160. I don't want to give it too much room, but looking for a pullback buy where we undercut that 20-day moving average and the support gap low. The buy would be on the re-enter of the support gap low. Coinbase, we see Bitcoin nearing a potential breakout. Looking for a pullback into that 10-day moving average and gap zone at 335, and then the stop would be 1 or 2% there. Probably won't buy that on strength. ASTS looked like it was going to get going on Thursday, but reversed and closed a little bit red. This is one that's moved up 100% in just a couple weeks. So a pullback in that support gap area is where I'll be watching for buying support, kind of a higher low there, and then stop would be the low of that shakeout. And then APLD, the last long, just kind of chopping between the 5, the 10, the 20-day moving averages and the HVC. But if we zoom out wider, you could see a nice big gap, or sorry, nice big base, rally into new highs, and then we're just basically retesting the breakout level at this point. So if we do have a market where instead of pulling back after 99, we accelerate from 99 to that 118 level of exposure, this is a name that has a nice tight pivot. You buy through the breakout or the pullback into the HVC. Stop would be under the low of the pullback. And this is one that you could play for a little bit longer move because the pivot's so tight, because the overall structure, you have a nice big base, it's breakout retest. Um, it still gives you the ability to kind of play it for a longer move instead of just like a 1 day or 2 day pop. So a name that I wanted to put on your radars. Next, we go to the short setups, and I've got about double, 18 of them to cover. We'll do it a little bit quicker, but just wanted to put a bunch of these kind of secondary names on your radar because if we do pull back from that 99 exposure, from that extended index, I think we're going to see momentum dry up, and a lot of these high flying names can shrink very quickly. So if you do like to short, here's a good watch list for you. First, we have CRCL. Big time relative weakness, not railing with the rest of the market, was one of those momentum names that started to decline earlier. Went from 300 down to 173. Had a little bit of a bounce on Thursday with a gap up, but not as much strength overall. Like CRWV got through the key moving averages and was up like 8%. This only up 6.2%. We still have this resistance gap that we couldn't get through, even with intraday action on Thursday. So looking for an uppercut and fail at the resistance gap high, right around 193. And then stop would be really tight because we're still in an uptrending market. All of these are kind of trying to time the reversal. And whenever you do that, you can't stay wrong on any of these trades. You should never stay wrong on a trade, but especially if you're trying to time a trend change, stay on the correct side of the VWAP. If we rally through the VWAP, you need to take the loss or take the stop. But that's the area that I'll be watching for with CRCL. SEZL, this is not ready quite yet, but looking for a blow off top move. We've gone from $24 to $180 in just a couple weeks. If we get another gap up, I'll start to look for a morning rally, then a VWAP loss as the short entry. The stop would be the high of the day, and I would try to trade this down to the 20-day moving average at 140, maybe even lower to the 50-day at 108. Especially if this like gaps up, has a good day on Monday, and then gaps up again on Tuesday, that would be an A plus blow off top. ACHR, this name really hasn't been participating. It's been a growth name that's made a big move from $3 up to $11, then from $5 up to 13. But if you look at the structure of this compared to the rest of the market doesn't have a gap down. This has one gap down, two gap downs, three gap downs. The market's not at the 50-day moving average. This had a wedge drop on Tuesday under the 5, the 10, the 20-day, and then just bear flag into the 50-day, the other 2 days. So looking for a breakthrough today's low as the entry. The stop would be the 20-day moving average. You would also be breaking through $10 at that area, which is another key spot, and kind of accelerating down. So I think this is a really good short setup to watch. If you need something more liquid, we have Palantir, which was the first liquid leader to start to break down. We saw this distribution day on June 5th, but the market wasn't ready to roll over. We still had lower exposure overall in the market. So we saw this distribution day followed by a gap up and a rally into new highs. Not the same here, where we saw a distribution day, a 1 day gap up, but then follow through to the downside. That's a change in character. When that happens after a stock has already gone from $6 up to $140, then you start looking for some short setups, especially if the indexes and the rest of the market are extended. So just looking for a breakthrough. Thursday's low, stop would be Thursday's high above the key moving averages there for PLTR. Root, another name that has some weakness, actually has, I think this is a gap down. Yeah, gap down. Don't have a couple of these gap downs drawn. My bad. But two gap downs from the top, big distribution on the 25th, bear flagging the 5 day, and then weakness the rest of the week. Overall, this has already gone through a monster move from $3 up to $180 over the last couple of years. Now we put in this big base, we uppercut and fail the base breakout, and then we accelerate through the key moving averages, bear flag into the 20, distribution, bear flag, and then some weakness while the general market is rallying. So instead of trying to play like a high flying move like SEZL, if you don't have the experience trading a blow off top, these are the types of setups that you probably have a little bit more experience with because you have a nice kind of tighter pivot. You're buying or you're shorting through the low, stop would be the high. You're probably more familiar with that type of trading versus, and I have more success trading the stocks that have already shown weakness versus trying to time the top on something like SEZL. But 1 day trades on blow off tops usually are more rewarding than like a base breakdown. So root, kind of the flip side of that. Tesla, very, very weak. We had the first time Trump and Elon got into that argument on June 5th, big distribution down 14%. Pretend like everything was ready or all well. We got through the key moving averages just to put in a lower high overall. Lose the 5, the 10, the 20, bear flag into them. Then we lost the 50 and the 200-day, rallied back into that area when the indexes were rallying. And now Elon's starting his own political party. I'm sure Trump's not going to like that, and we're probably going to see retaliation. So this is a liquid stock that we're rallying into all the key moving averages at this point. A gap down opening range break is a short versus the highs from Thursday, and this is something that can really unravel if Trump wants to retaliate. TSSI, much less liquid, but a name that's gone from $7 or I mean even down to $6 up to $30 in a short amount of time. Gap down, rallied into the resistance gap earlier into the week. This is one where I'm looking for just an uppercut and fail. That would be the entry. Um, you could do a gap down opening range break, and then the stop would be the high. Either way, your stop is going to be nice and orderly, right at 29.30, 29.40, around that area. And then just looking for a pullback into the 20-day EMA support gap at $23 for the first area to cover, or the 50-day moving average and secondary gap at 18. RDW, another kind of high moving growth stock that has not rallied like some of the others. We had a good move off the low into this resistance gap. We had some distribution, rallied up, big gap down on the 17th. Weakness through the 20-day moving average, lower high rally, fell through the key moving averages again, attempted to rally into that area with a strong market, but not getting through the key moving averages. Looking for follow through to the downside as a potential short. Stop would be Thursday's high. DXYZ, we covered this last week. We were looking for a rally into the 200-day moving average and resistance gap area. We got that on Thursday, and then a nice big reversal, ending Thursday down 2%. That was really probably the A plus setup for the short for the best risk reward. Now we're just looking for follow through to the downside with a stop at the 200-day moving average. Overall, lots of room down after that explosion in November to December of last year. PDYN, this has been on the short watch list for a while, rallied into a resistance gap, faded to the 20-day, lower high, lower low. Then we actually looked like we were trying to break out here, but followed it up with a unfilled gap down, then a wedge drop, then a bear flag into those key moving averages, and just weakness on Thursday overall. Just looking for a break through Thursday's low, or if you uppercut and fail at that 20-day EMA, that's a potential entry on the short as well. And then just looking to play this maybe to the 50-day or even further if we see the market fall apart as well. RCAT distribution with a big gap down on the 17th, bear flagging in the 20-day, lower high, lower low. An uppercut and fail of the 20-day moving average and gap zone at 730 is the short entry. Stop would be at that 760 area for a lower high. BFLY, this continues to just chop right under $2. Could start to see this waterfall if we take out Thursday's low. Stop would be Thursday's high and the 10-day EMA. VUZI, another name that had a monster move in November, put in a lower high here and has a resistance gap that we touched on Tuesday. Followed it up with follow through through the 5, the 10, the 20-day EMA, down 7% on Wednesday. Bear flag 2 times, failing to get through the resistance gap above the key moving averages, and now we're just looking for follow through to short there. QMCO, this is one of my favorite stocks to short. It had that massive move in November and December from $3 up to $90. Continues to put in lower highs. Now actually putting in lower lows, and now we get a change in structure. Gap down on Wednesday of last week. Little rally with the rest of the market strong. Now we're just looking for follow through under Thursday's low as an entry. Stop would be the 10-day EMA. GRRR, weakness overall, 2 resistance gaps down while the indexes don't have any. An uppercut and fail of that resistance gap high would be my entry, but more of like a secondary name that I'm just using to see if we're getting momentum to dry up versus still a strong momentum market. SERV, break of the structure down to the 200-day moving average. So we had lower highs, lower low, lower high at that resistance gap, followed it with a gap down, just tight trading under the 20-day moving average. A loss of the 200-day and Thursday's low is the entry. Stop would be Thursday's high. This was one of the first shorts that we got working where we had a big move on the 27th of May, but then gap down, kind of barcoded, trading sideways with that resistance gap. Never closed above it, so we saw sellers come through at the end of the day, followed through the 50-day moving average, all the way down from, what was this, 250 down to 175, bounced into the 50-day, and then resisted at that area. Now we're putting in a nice pivot here. Um, Probably the correct entry was on Thursday, but if we get another uppercut and fail of $2, then that would be the entry versus Thursday's high or Friday's high, or sorry, Monday's high, whatever is higher, and try to play this for another move, kind of a lower low into that support gap at 169. The last stock to cover is NAAKA. This has been on the short watch list for a couple weeks now. We just keep trading sideways after uppercutting the previous highs from $31. We got to $34 and then immediately failed all the way down to 10. Rallied, lower high, starting to feel heavy, get under those key moving averages. And now if momentum actually gets taken out of the market, this is something that can just fall apart. So looking for a break under Thursday's low at 1243. Stop would be Thursday's high and the resistance gap right here. And this is a name that, because it's thinner, I wouldn't size it up as much, but it's a name that we could see a quick 20, 30% move down. All right, that's going to be the weekly prep video for July 7th to the 11th. If you guys enjoyed the video, please leave a like and subscribe to the channel, and make sure you're taking advantage of the risk-free, 100% free 30-day trial of DeepView in the comment section and the description of the video. Tomorrow, I'll be releasing a video about how I use DeepView and all the watch lists, screeners, and dashboards that I use, so you can use DeepView exactly how I do. Hope you guys have a great rest of your week, and I'll see you guys in the next video.